Let us begin with a simple but uncomfortable truth. The global silver market was never as solid as it looked. What recently collapsed was not silver itself, but trust. Trust in pricing, trust in paper contracts, and trust in institutions that claimed control over a metal they barely possessed. For decades, the heart of the silver pricing system has been the London Bullion Market Association, better known as LBMA. Officially, it is presented as a neutral marketplace where price discovery happens smoothly. Unofficially, it functioned as the central nervous system of paper silver, a place where contracts, not metal, decided global prices. Here is where the illusion begins. The vast majority of silver traded globally is not physical silver, it is paper claims, futures contracts, unallocated accounts, ETFs, and derivatives. For every single ounce of physical silver available, there exist dozens, sometimes hundreds of paper claims. As long as nobody asks for delivery, the system survives. The moment too many players demand actual metal, the system starts to fracture. And fracture it did. What triggered the shock was not a single event, but a strategic shift led by Russia and China, nations that have quietly studied Western commodity markets for years and identified their greatest weakness: over-leverage and under-delivery. Unlike Western financial institutions, Russia and China do not treat silver as a speculative asset. They treat it as a strategic material, essential for military electronics, solar panels, advanced manufacturing, and monetary diversification. While Western banks created synthetic silver through financial engineering, these countries focused on physical accumulation. This difference in philosophy is everything. When Russia and China began increasing bilateral trade, settling contracts outside the dollar system, they also began demanding physical settlement for commodities. No rolling contracts, no paper offsets, real metal, real delivery. This single change placed immense pressure on the LBMA system. Because the truth is simple. LBMA does not have enough silver. LBMA vaults hold only a fraction of what their contracts represent. The system relies on confidence that most participants will never demand delivery. But when sovereign buyers, not hedge funds, not speculators, but governments, start asking for metal, the math stops working. This is where exposure turned into panic. Suddenly, delivery times stretched, premiums disconnected from spot prices. Physical silver prices in Asia began diverging sharply from London benchmarks. The so-called global price no longer reflected real supply and demand. It reflected financial stress. And this is why the word collapse is not exaggeration. A market collapses when its pricing mechanism loses credibility. When participants stop believing the quoted price represents reality, the market fragments. That is exactly what happened. Asia, particularly Shanghai, began operating on physical first pricing, while London remained trapped in its paper framework. This divergence is lethal for LBMA dominance, because once pricing authority is questioned, control disappears. Russia and China did not announce an attack on LBMA. They didn't need to. They simply opted out of a system that no longer served their interests. By bypassing London benchmarks and prioritizing physical settlement, they forced the West into an uncomfortable position. Admit shortages or lose relevance. Western financial media framed the issue as logistical disruptions or temporary supply tightness. But insiders understood the deeper reality. This was not a supply shock. This was a systemic exposure. The silver market had been running on leverage similar to pre-2008 mortgage securities, safe as long as confidence held. Fragile the moment reality intervened. What makes this moment historic is timing. The world is already fragmenting financially. Dollar dominance is under pressure. Sanctions have weaponized finance. Trust between blocs has eroded. In such an environment, paper promises mean very little. Physical control means everything. Silver sits at the intersection of money and industry. That makes it uniquely dangerous for a paper-based system. Unlike gold, silver is consumed. Unlike fiat currency, it cannot be printed. And unlike derivatives, it cannot be conjured with accounting tricks. When Russia and China increased their demand for real silver, not contracts, not ETFs, but metal, they exposed the foundational weakness of the Western precious metals market. LBMA did not collapse overnight. It cracked. And cracks spread fast. This is not about conspiracy. It is about structure. A system designed for financial efficiency collapsed when confronted with geopolitical reality. Markets built for speculation failed when confronted with sovereignty. And this is only the beginning, because once one metal breaks free from paper pricing, others follow. Gold, copper, rare earths, energy. The entire architecture of Western commodity control faces a reckoning. To understand why the silver market cracked, we must confront the mechanism that powered it for decades. The collapse did not begin with Russia or China. It began much earlier, inside Western financial engineering itself. At the core of the silver market lies a simple trick: paper multiplication. In theory, every futures contract, unallocated account, or ETF share represents a claim on silver. In practice, most of these claims are never meant to be fulfilled. They are designed to be traded, rolled over, offset, and settled in cash. The system works only if participants accept that silver is a financial abstraction, not a physical necessity. This is where the structure becomes fragile. The London-based pricing framework, anchored by the London Bullion Market Association, evolved into a massive over-the-counter derivatives network. Unlike transparent exchanges, this market operates largely off-balance sheet. Banks trade promises with banks. Inventory numbers are opaque. Audits are limited. What matters is liquidity, not metal. For years, this model delivered stability. Prices stayed contained. Volatility was suppressed. Industrial users could hedge cheaply. Financial institutions profited from spreads and leverage. Everyone believed the system was efficient. But efficiency came at a cost. Reserves without resilience. Paper silver expanded far beyond physical supply. Estimates vary, but conservative analyses suggest leverage ratios of 50.1 or higher. That means 50 claims for every ounce that actually exists. This is not fraud by definition. It is standard practice in derivative markets. The problem arises when too many claims are tested simultaneously. That moment arrived when geopolitics changed the rules. Unlike hedge funds, sovereign states do not hedge for profit. They hedge for security. When Russia and China assessed the Western financial system, they reached a cold conclusion. Paper assets are liabilities disguised as liquidity. Sanctions accelerated this realization. Dollar reserves were frozen. Access to Western clearing systems became conditional. Suddenly, holding paper claims issued under Western jurisdiction looked risky. Silver, once treated as a financial sideshow, became strategic. China's industrial demand exploded. Solar manufacturing alone began absorbing enormous quantities of silver. Russia, cut off from Western capital markets, turned inward and eastward, prioritizing tangible reserves over financial instruments. Here is the critical shift. These players did not want price exposure. They wanted possession. When requests for physical delivery increased, bullion banks faced an uncomfortable choice. Either deliver metal they did not have or discourage delivery through delays, premiums, and cash settlement incentives. They chose the latter. Delivery timelines stretched quietly, minimum lot sizes increased. Temporary shortages became recurring. Official spot prices stayed calm, but physical premiums surged. This divergence signaled stress. The market was saying one thing, reality was saying another. This is how paper systems unravel. As long as cash settlement is accepted, leverage survives. The moment delivery is demanded, leverage becomes exposure. And exposure spreads fear faster than any headline. Western banks assumed sovereign buyers would behave like financial participants. They were wrong. States operate on different incentives. They are willing to wait. They are willing to stockpile. And they are willing to walk away from benchmarks that no longer serve them. This is precisely what happened. Asia began pricing silver differently. Physical availability mattered more than London quotes. Local premiums became the real signal. Over time, the global price fractured into regional truths. That fracture undermined the authority of LBMA pricing. Once a benchmark loses universality, it loses power. And without power, leverage becomes dangerous. Western institutions attempted to stabilize the system through messaging. They spoke of market depth and ample liquidity. But liquidity without deliverability is noise. Now, the market understood this. So did industrial buyers. This created a feedback loop. Rising physical demand tightened supply. Tight supply increased premiums. Higher premiums exposed paper weakness. Exposure encouraged more delivery requests. And the cycle continued. What made this moment irreversible was coordination. Russia and China did not need to publicly align. Their actions spoke louder. Bilateral trade settled outside Western benchmarks. Long-term contracts emphasized physical settlement. Strategic reserves quietly expanded. The West, by contrast, remained trapped in short-termism. Banks optimized quarterly returns. Funds chased yield. Regulators assumed stability because prices looked stable. But stability was an illusion created by paper volume. When confidence broke, there was no emergency lever left to pull. You cannot print silver. You cannot settle industrial demand with derivatives forever. You cannot restore trust once physical shortages are visible. This is why central banks could not intervene meaningfully. This was not a monetary crisis. It was a material crisis. The silver market exposed a deeper flaw in Western finance, the belief that abstraction can permanently replace substance, that leverage can outpace reality, that trust can be engineered indefinitely. Russia and China did not destroy the system. They revealed its limits, and revelation is more dangerous than attack. Because now every participant must ask the same question. If silver pricing was built on paper, what about other commodities? What about gold, energy, food, rare metals? Every systemic collapse begins at its weakest point. In the Western-controlled commodity world, silver was not the largest market, nor the most prestigious, but it was the most fragile. And fragility is what breaks first. To understand why silver cracked before gold, oil, or copper, we must look at its unique position in the global system. Silver sits at the intersection of money, industry, and leverage. That combination makes it exceptionally sensitive to stress. Unlike gold, silver is not primarily hoarded. It is consumed. Every smartphone, but every solar panel, every electric vehicle, every advanced weapon system requires silver. Once used, much of it is gone. Recovery is expensive and inefficient. This creates a quiet but relentless drain on available supply. At the same time, silver inherited a monetary legacy. For centuries, it functioned as money. That history never fully disappeared. Investors still treat silver as a hedge, a store of value, a crisis asset. So silver must satisfy two opposing demands simultaneously: industrial consumption and financial hoarding. That tension is dangerous for a paper-based system. Western markets attempted to resolve this tension with abstraction. Futures contracts, ETFs, unallocated accounts, and swaps created the illusion of abundance. Supply could be expanded instantly on screens, even if minds could not expand in reality. This worked as long as trust remained intact. But silver has one fatal characteristic for paper markets. It is too small to absorb sovereign demand quietly. When China accelerated its industrial expansion, silver demand rose structurally, not cyclically. Solar capacity targets alone required amounts of silver that dwarfed previous forecasts. This was not speculation, this was policy. Meanwhile, Russia, operating under sanctions pressure, reassessed its reserve strategy. Paper assets were vulnerable, physical commodities were not. Silver, cheap relative to gold and essential for defense technologies, became strategically attractive. Here is where the chain reaction began. Unlike gold, silver inventories above ground are limited and dispersed. Much of it sits in industrial products, not vaults. So when large buyers step in, they immediately tighten the physical market. There is no deep buffer. This tightening should have raised prices sharply, but it didn't. Why? Because paper supply expanded to suppress volatility. More contracts were created, more liquidity appeared, prices stayed calm. But calm prices during tightening supply do not signal stability. They signal distortion. This distortion pushed stress elsewhere, into premiums, delivery times, and regional markets. Physical silver in Asia began trading at prices that no longer matched Western benchmarks. That divergence was the first visible crack. Silver broke first because it exposed the lie faster. Gold enjoys prestige and political protection. Central banks hold it. Interventions are subtle but powerful. Silver has no such shield. It is treated as a minor metal, yet demanded like a critical one. Energy markets, by contrast, are politically sensitive and heavily managed. Food markets are subsidized. Rare earths are strategic and tightly controlled. Silver fell through the cracks. And once it cracked, it sent a signal. The signal was simple. Paper pricing cannot override physical scarcity indefinitely. That signal was heard loudly in Asia. Pricing power began to migrate. Instead of looking to London, buyers increasingly referenced physical availability in regional hubs. The idea of a single global price began to dissolve. This is existential for institutions like the London Bullion Market Association. Their authority depends on universality. Once markets fragment, benchmarks become opinions, not anchors. Fragmentation also changes behavior. Industrial buyers stop trusting futures hedges. They secure supply directly. Governments build stockpiles. Producers seek long-term contracts rather than spot exposure. Each of these choices reduces liquidity in paper markets. Reduced liquidity makes leverage more dangerous. This is how a chain reaction forms. Silver's break does not stay confined to silver. It forces a reevaluation across commodities. Gold is watching, copper is watching, even oil, despite its scale, is watching, because the same structure exists everywhere. Paper claims far exceed physical control. And what silver demonstrated is that the system is stable only under cooperative assumptions. That markets assume no one will demand too much delivery too quickly in too coordinated a manner. Geopolitics shattered those assumptions. The world is no longer cooperative. It is segmented, and segmented worlds demand sovereign pricing, not centralized abstraction. Silver was the first casualty because it lacked defenders and carried contradictions no system could hide. Too industrial to hoard easily, too monetary to ignore, too small to absorb stress quietly. Once silver broke, it validated a strategy already forming among non-Western powers: bypass paper markets, prioritize physical control, and price commodities closer to reality. This is not de-dollarization in theory, this is de-financialization in practice, and that is far more dangerous for Western dominance. Because currencies can be defended with policy, financial systems can be supported with liquidity, but physical shortages cannot be legislated away. When a financial system fractures, the damage is never evenly distributed. Some players absorb losses quietly, some escape early, others are left holding instruments that no longer behave as promised. The silver market breakdown follows this exact pattern. The first pressure point is the banking system. Bullion banks built their business model on arbitrage and leverage. They borrowed silver cheaply, sold paper claims aggressively, and relied on the assumption that delivery would remain rare. This worked as long as volatility stayed low and trust stayed high. But once physical demand increased and delivery risk returned, this model turned toxic. Banks now face a structural mismatch. Their liabilities are immediate. Their assets are conditional. When clients demand delivery, banks must either source metal at rising premiums or offer cash settlement. Both options damage credibility. One drains balance sheets, the other signals weakness. This is why risk desks grew nervous long before headlines did. The problem is not insolvency in the traditional sense. It is liquidity under physical constraint. Central banks can provide currency, they cannot provide silver. This distinction matters. In past crises, liquidity injections stabilized markets because assets could be refinanced. In the silver market, refinancing does not create metal, it merely delays reckoning. The second group exposed is ETFs and unallocated holders. Retail investors often believe ETFs represent stored silver waiting in a vault. In reality, most ETFs rely on complex custody chains, sub-custodians, and leasing arrangements. The metal exists, but not always where or how investors imagine. Under normal conditions, this structure is invisible. Under stress, it becomes critical. If redemption requests spike, ETFs must source physical silver quickly. If physical supply tightens, ETFs face rising costs or settlement delays. While prospectuses allow for cash settlement in extreme cases, that option undermines the core promise investors believe they are buying. This creates a psychological break. Investors don't panic when prices fall. They panic when instruments behave differently than expected, when silver exposure stops acting like silver. That realization has already begun spreading quietly. Some investors moved to physical possession. Others shifted to long-term holding strategies. Trading volumes in paper markets became more erratic. Liquidity fragmented further. This behavior feeds back into the system. As paper liquidity dries up, price discovery weakens. Weak price discovery increases volatility. Volatility increases margin requirements. Higher margins force leveraged players out, and forced exits accelerate stress. The third casualty is industrial supply chains. For manufacturers, silver is not an asset, it is an input. Predictable pricing matters more than low pricing. When benchmarks lose credibility, procurement becomes complex and risky. Companies respond by locking in long-term contracts, prepaying suppliers, or building inventories. All three actions remove silver from the spot market. That tightens availability further. This is how industrial demand amplifies financial stress. In the past, financial markets absorbed shocks and smoothed supply. Now they transmit shocks into the real economy. The direction has reversed. Smaller manufacturers feel this first. Larger firms adapt. Some pass costs on. Others reduce production. In sectors like solar energy, even small disruptions cascade into policy challenges. This creates a political dimension. Governments begin asking uncomfortable questions. Why is a critical industrial metal priced through a system that cannot guarantee delivery? Why does a benchmark located thousands of miles away dictate costs for domestic industries? These questions erode institutional authority. This brings us back to the role of the London Bullion Market Association. LBMA's power was never enforcement, it was coordination. Its relevance depended on voluntary participation and trust. Once major players stop referencing its prices, its influence diminishes rapidly. This is not collapse through scandal. It is collapse through irrelevance. Markets move where trust moves. Retail investors, meanwhile, face a different dilemma. Those who believed silver was a simple hedge discover complexity they did not price in. Physical silver carries storage and liquidity costs. Paper silver carries counterparty risk. There is no perfect instrument. This forces a reassessment of risk tolerance. Some investors will exit entirely. Others will concentrate positions. Both reduce market depth. And reduced depth increases fragility. This is the paradox of modern finance. Instruments designed to increase access end up concentrating risk when stress arrives. The winners in this environment are not speculators. They are holders with patience. Those who control physical supply without leverage gain optionality. They are not forced sellers. They are not margin sensitive. They can wait. This describes sovereign actors far more than financial ones, which is why the silver breakdown is not just a market event. It is a power shift. Pricing power moves toward those who can deliver. Contract terms favor those who hold inventory. Benchmarks favor those who trade physical first. Western finance excelled at abstraction. The emerging system rewards possession. This shift does not happen overnight. It unfolds unevenly. There will be rebounds. There will be official reassurances. There will be temporary calm. But structurally, the direction is set. Paper dominance is giving way to physical constraint. In such an environment, every participant must adapt. Banks reduce leverage. ETFs tighten rules. Investors rethink exposure. Industries secure supply. Governments reassess benchmarks. None of these adjustments restore the old system. They build a new one. In Part 5, we will step back and look forward. We will explain what a post-LBMA silver market looks like, how pricing may evolve, and what this signals for the future of global finance. The collapse phase is only the middle of the story. What comes next will define the next decade. Every financial era ends the same way, quietly at first, then suddenly, and finally permanently. The silver market is now entering its final phase of transition, not from order to chaos, but from one pricing regime to another. The collapse of trust in the paper-heavy silver system does not mean silver stops trading. It means who decides the price changes. For decades, pricing authority rested in London through the London Bullion Market Association framework. That authority was never based on ownership of metal. It was based on coordination, leverage, and global acceptance. Those pillars are now weakening. What replaces them will not be a single new master benchmark. The future is more fragmented, more physical, and more regional. The first change is philosophical. Silver will no longer be priced primarily as a financial instrument. It will be priced as a strategic material. That subtle shift has enormous consequences. Financial assets can tolerate leverage. Strategic materials cannot. When security and industry depend on supply, delivery matters more than efficiency. This changes behavior across the chain. Producers will prefer long-term contracts with guaranteed offtake rather than exposure to volatile spot markets. Industrial buyers will lock in supply even at higher prices to avoid disruption. Governments will treat silver inventories as infrastructure, not investments. These choices reduce liquidity in paper markets permanently. As liquidity declines, paper benchmarks lose authority. They may still exist, but they stop being decisive. Prices quoted on screens become references, not truths. This is how pricing power migrates. The second change is geographic. Asia will play a larger role in physical price discovery, not because of ideology, but because of proximity to demand. Manufacturing hubs, energy transitions, and technology supply chains are concentrated there. Prices that reflect physical availability will increasingly originate closer to consumption. This does not require a formal announcement. It happens organically. Traders reference local premiums. Contracts reference alternative benchmarks. Over time, the market simply stops looking to London first. This is how empires fade, not through defeat, but through irrelevance. The third change is structural. Silver pricing will become multi-tiered. One price for paper exposure, another for immediate physical delivery, another for long-term contracts, another for strategic reserves. This already exists informally. The difference is that the gap between these tiers will widen. When markets were stable, the differences were small. Under stress, they become signals. A rising physical premium over paper price is not noise, it is information. It tells you where power lies. In this future, volatility does not disappear. It changes character. Prices may move less in calm periods and more during stress. Spikes will be sharper, corrections will be faster, because inventories will be tighter and buffers thinner. This environment punishes leverage and rewards patience. For investors, this means silver will no longer behave like a simple hedge. It becomes a conditional asset. Its performance depends not only on macroeconomics, but on logistics, geopolitics, and industrial policy. Those who understand this will adapt. Those who expect old patterns will be surprised. For banks, the lesson is harsh. Commodity finance can no longer rely on infinite abstraction. Balance sheets must reflect deliverability, not theoretical exposure. Leverage will decline, returns will shrink, but stability will improve. This is not a crisis of capitalism, it is a correction of excess. For governments, the implications are broader. If silver pricing can fragment, so can other strategic commodities. That forces a reassessment of how value is measured globally. The assumption that Western financial centers automatically define prices is no longer safe. This is why silver matters far beyond its market size. Silver is not collapsing in isolation. It is signaling a transition from a world where finance led reality to one where reality reasserts itself over finance. That transition is uncomfortable. It exposes weaknesses, it forces change, but it is not catastrophic. Markets adapt, systems evolve, new equilibria form. The mistake would be to assume this is temporary. The old silver system was built for a globalized world with shared trust, low geopolitical risk, and confidence in institutions. That world no longer exists. The new world demands redundancy, control, and physical assurance. Silver simply reached that conclusion first. History will likely look back at this period not as the silver collapse, but as the moment commodity pricing reconnected with the physical world. After decades of abstraction, that reconnection was inevitable. The story does not end with LBMA losing influence. It continues with new mechanisms, new hubs, and new rules, less elegant, less centralized, more resilient. And in that sense, what we are witnessing is not failure, it is reset.